Hello and welcome to another episode of the Saxo Market Call podcast here in our little studio in Copenhagen. As always, my name is Søren Otto and I am your host, and today I am joined by, I would almost say a frequent guest around these times, John J. Hardy, Chief Macro Strategist, and Althea Spinozzi, our head of fixed income strategy, which it has been a while since you've been here, Althea. Very happy to see you both.
Very happy to be here.
Happy to be here, and don't undersell our studio. I wouldn't call it that little. It's a pretty nice digs here.
Oh, you're right. I just, you're actually right.
You're trying to make it sound cozy or something, and it is cozy to be with you guys. But it's a nice studio.
I mean, being the only Danish here, I have to stand up for the word cozy because that is sort of the pride of Denmark to talk about how cozy it is here.
Well, cozy is a bad translation of a hyggeligt, but we'll leave that there.
But it's the only one we got.
Yeah.
So everyone, come to Denmark, experience the real hygge instead of just talking about being cozy every time you hear about us. Anyway, that's not really what we're here to talk about, luckily, and then otherwise I think everyone would flee
I think
pretty quickly.
People are tuning out already,
Yeah.
maybe. Okay.
So speeding into, obviously, we're a week removed from the U.S. election now, and we need to just, I guess, grab our bearings, what's going on in the markets, talk a little bit about bonds. I mean, fixed income has moved quite a lot as well. We also need to go to Germany. I understand that there was a relatively new announcement just minutes before we went into the studio. And then, yeah, let's see where it takes us from there. But, John, I want to start with you. 1 week away from the U.S. election, we were here on sort of a frantic episode Wednesday last week where you'd been up for something that sounded like 24 hours.
Almost.
Yeah, so hopefully you've slept a little bit since then. And with a better overview of the reactions, what's your main takeaway, or what's your general vibe regarding the election?
Yeah, I'm reluctant to take too much of a takeaway, but and more of observations, and a lot of those observations are similar to what we were looking at last week. We saw, as we noted last week, if I recall, I'm a bit hazy.
Understandably.
How conscious are my memory is a bit fuzzy of that day at this point, but that you sort of charted out some of the reaction functions we would have to this election. And those essentially proved all right. Sort of the dollar would, okay, clear Trump victory means the dollar will pop. We'll see equities go up. We'll see small caps outperform. We'll see the financials doing better because of deregulation hopes, etc. All that stuff kind of played out. But sort of beyond that now, what has been the follow-on? The one thing we got quite wrong, by the way, and poorly so. At least I got wrong. I think Uru was hinting to a post-election correction. That was gold, and gold dropped a lot, and we described it as being possibly a function of the fear levels around the election, some kind of contested election scenario, these types of concerns. All that deflating meant that volatility fears sort of across asset classes could fade away, and that sort of safe haven bid behind the last leg higher, and gold could deflate. But follow-on reaction-wise, I think it's been kind of interesting to see just the ongoing explosion in Tesla shares and sort of this speculative cluster that we've talked about before. The old stonks, stock bros, whatever you want to call them, and things like Bitcoin. So Bitcoin ripping higher, almost touching $90,000. Just incredible price action there. Yeah. It just feels like there's like really, really strong animal spirits in the most speculative spaces. I have my concerns about that. We could dig into that later. Some interesting things, potential appointments that are probably going to come to be the actual appointments from the Trump administration. What does that mean for geopolitics, trade wars? These questions, the market doesn't care. It's just they're really happy and wants to speculate, at least if we're talking some of these spaces in the U.S. I think I'll say when we look at other signs of risk-taking, or maybe it's not just risk-taking, fixed income and high yields in the U.S. I mean, we've seen a collapse in the high yield spread versus U.S. Treasuries. You're saying, well, there's a 2007 low. Yeah, but this is like the most compressed these spreads have been almost essentially in history. So curious what your take is on that, and then we can segue maybe Søren as well into Germany a bit later.
I think, John, that what's happening here is investors wake up to the fact that the same kind of backdrop, a macroeconomic backdrop that we've seen in 2022 and 2023 might be still valid also for 2025 with Trump becoming the next president of the United States and coming in with a red sweep. So realistically, when we look at fixed income, we see that the only way not to lose value in your portfolio, in your fixed income portfolio, was to locking in positions that were providing carry and above average yield. And those kind of assets that have been providing that has been emerging markets and junk bonds. So now the problem with emerging markets is that it looks like the US dollar continue to rip higher.
And that means tighter financial conditions for emerging markets.
Exactly, especially in an environment where they might be facing to refinance their debt. So they might not be in a favorable kind of position. But instead, the junk bonds, especially with the prospect of a reacceleration of the economic activity in the US, they still look underpinned, especially when we think that in 2023 and 2024, a lot of these companies have been refinancing their debt and pushing maturities down to 3 to 5 years. So basically what's happening here is that investors perceive a diminished refinancing risk for the junk bond space in the US. And that's especially true, especially when we compare it with European junk bonds. Because in Europe, there has been also spread compression, but spreads are nowhere near the lows that we have seen in 2021 and 2019.
Is that in part on the QT from the ECB? I mean, so some of the sovereign stuff is crowding out because of QT is maybe crowding out some of the ability for credits to attract that kind of inflows, or?
So it's true that QT is still the backing drop of European sovereign markets. And it's also true that since September, the ECB started to weigh down also the PEP facility that were holding a lot of the purchases that they made during the pandemic. However, I think that what we see in European markets is really much of a macroeconomic and political story. What's happening in Europe? We have seen economic weakness in Germany, and now we see political uncertainty. And this is obviously bearish for bonds. And I believe that what's happening in European market is a reset of what is expectation of what's happening ahead of us. So are bonds Europeans safe haven in light of what's happening today? And that's probably why we have seen also things like the swap basis going negative.
Very, very technical term to discover, and I'm not sure I even understand it fully. But basically, it's what is it a function of, this basis swap, and why is it a big deal, if it is a big deal?
So the big deal is that in a euro swap, you also have to price counterparty risk. So since the euro was formed, so 2000, the spread between bond yields and the euro swap has been always positive, because obviously
Germany's a safe haven, and
exactly,
yeah.
So what happened now is that if that swap basis gets negative, it's a perception that maybe bonds are not as safe as taking counterparty risk in this swap. It's true that there is a lot more to add to it, like, for example, US dollar liquidity versus euro liquidity and so forth. But the way I read it, especially because we had the dip into negative territory this week, basically in these days, when the German government is collapsing, is just telling me that markets are really double-doubting what is happening in Germany, and they don't want to take duration in German government bonds.
So there's a discount there related to political uncertainty.
Exactly.
Seems to be the clear point.
Yeah, so to put it very simply, it's sort of Germany's position as whether it's relative to the EU more safe or less safe, or more trustworthy or less trustworthy, in its most simple form. Is how
Yeah,
I
I would put it like that. But what does it mean for investors? And I think that also when we move to Europe, investors, fixed income investors, don't have much choices, in the meaning that we have an uncertain situation going on with Germany. We have a president in the United States that might be inflationary also for Europe. And we have a war, basically in Ukraine, that we have to bend the burnt of the cost of it if Trump basically steps away from there. So what's happening here is that German bonds are rightly selling off because their yield doesn't compensate on monetary and inflationary risk. And what we are seeing is also spread compression against other European sovereigns. And my thesis, I know that, John, people normally don't like to look at the periphery, and especially they are really concerned about Italian BTPs. But if we look only at European sovereigns per se, Italian BTP might be the only instruments that they can provide some sort of buffer against inflation and monetary policy risk at this point in time. And another instrument that can serve as a buffer is European junk credits and also investment grade junk credits. And that's why
high
they
yield.
And high yield
Yeah.
bonds. And that's why we see the spread compressing against the Bund as well.
Interesting.
Okay. So obviously a lot is happening. I just want to have a sort of a quick round out in terms of the U.S. election, because we have seen it does seem more or less clear that the Trump will be getting a sweep, but it isn't official yet.
No, it's not official, and it's just incredible. These last, just it's an embarrassment really for the U.S. to still be struggling with counting votes almost a full week here later after the polls closed. 214 to 205, the Republican lead to the Democrats in the House. It's not official. It is going to be official. They will win, but it's a question of, is it going to be sort of 7 or 8 seats or 10 seats or 5 seats? I'm not sure I quite understand. But a complete.
But what about the markets? Do you think they've priced it in?
No, there's no uncertainty about
Okay.
this outcome. But it's just embarrassing to me. So as a practical, the practical inability to tally votes.
Seems like it's almost been become part of the system that it should be difficult to tally those votes.
There are some states where how easy or difficult should it be? Should there be 19 different ways to vote, or one way to vote? The last time around, this was the biggest embarrassment was in Florida in 2000, if we recall, the incredible spectacle of these paper ballots and whether the poll was fully punched out and should it count or shouldn't it count. And Florida is one of the states that reports the fastest now because of that experience. And I hope this election experience sees Arizona and California get their business together for the next rounds. But who knows? It doesn't matter really in terms of the outcome this time, but it is a bit annoying.
So if we just look ahead, we're going into, at least in this part of the world, into winter and holiday seasons. We now have a new U.S. president, and we obviously have the debacle.
Not until January 20th, but he's making moves and making things that we know his administration will look like increasingly as that date approaches.
Exactly my point, that we will have that in January, and then we'll have the election in Germany in February. What is the market going to focus on? Is it just going to be smooth sailing until then, or are they going to react to everything Trump is going to do, or what?
Yeah.
What do you think is going to happen in sort of near future?
I really don't know short term, medium term, or long term to answer your question, but there is a
Thanks.
lot of policy. So why are you listening? There is a lot of policy energy behind a Trump 2.0 and a red sweep. And I think something that's emerged here over the last 24 hours is the not the announcement, but the sort of inside info or inside skinny from credible sources that he's looking to appoint Marco Rubio, the senator from Florida, to be Secretary of State, and somebody named Mike Waltz to be his national security advisor. And those two appointments are they're extremely hawkish on China, unabashedly so. And as well, both of them are skeptical about supporting Ukraine. They want to make deals, as Trump himself has expressed. That has huge implications globally, both for Europe, What is the ability to strike a deal? It doesn't have to be bad. It could also be good. It could be that they strike a deal and freeze things. You can have your opinions about whether that's good or bad for the longer term situation for Europe's security, but it means things calm down for a while. But how receptive would Europe be to this? And I don't think it's any coincidence, just to link back to our discussion on Germany and the political uncertainty and discount there, that the German government falls the day after the U.S. election.
No.
That is not a coincidence. And it has to do with the specific issue. The proximate issue was the finance minister not wanting to support the spending for, or additional spending for the Ukraine war without dipping into social spending, which Social Democratic Chancellor was dead set against. So clearly it's very concerning for Europe, but it's also has to concern us. What does a showdown with the U.S. and China look like? How will China respond? These are enormous questions. So I'm just a little bit reluctant, in short, to just sort of fully go behind this one-way speculative hurrah moment that the markets are seem to be indulging in when we see these kinds of very serious appointments and implications of those appointments shaping up with all the associated questions. So of course
but
we'll have
it's
to.
also true that normally, like leading to Christmas, it's always a very good and bullish
Yes,
time of the
often
year.
there is a seasonality. Often U.S. Equities, especially the run from Thanksgiving into the end of the year, but even earlier into the end of the year. I think John Otto is the great Bloomberg columnist, even saying this is outdoing the 1928 post-election rally. So we all came after 1928. That was 1929. I'm not going to make those kinds of comparisons. It just feels a bit over the top here. But there's some reasons behind it, and this will be a very pro-growth administration in many ways. But there's also some pretty darn big questions on the geopolitical side and on the how big and bad are the tariffs going to be, and what are the follow-on effects and the retaliatory moves by trading partners. I mean, there's just a lot of questions out there, as well as potentially market positive policy impulses here.
Yeah. No, go ahead, Althea. Sorry.
No, I'm a little bit cautious to use the terminology fiscal, but in reality, because basically Trump wants to remove the fiscal burden out of the U.S., but literally what he wants to do, it doesn't really spell good for the fiscal stance. And we have also probably a fiscal risk also in Europe. So I think that the theme in 2025.
So you mean worse fiscal deficits?
Yes, exactly.
Yeah, and then I've seen some interesting conversation around that, and there are those that are saying, well, you have Elon Musk talking about eliminating the U.S. deficits and eliminating the U.S. debt. Excuse me, to do that, you're going to be talking about
austerity.
Austerity and a catastrophic decline in demand from government spending. So, how much would Trump want to sign on to that? I'm not sure. But so the so-called tech bro nexus of people, and how much influence they get, and setting the agenda is very fascinating. I mean, they were very, very influential and helpful in Trump's chances in this election with their significant contributions. I think RFK at the margin was as well. Could have, maybe that was a 1% of the vote that switched because of his endorsement of Trump. I don't know. There's some that say he was actually quite decisive. It's hard to pick these things apart, but so it's interesting to see in any case how thoroughly the sort of free goodies for all sort of promises from the campaign are become the reality versus a more sober, cautious approach, at least on the fiscal side and the tax cut side. I think he's going to be quite strong on the geopolitical side and on the tariff side. And those two things aren't necessarily, have massive growth implications. Maybe quite the opposite in the short term. But yeah, so those are my sort of my thoughts at this point in time.
To try and wrap it up a little bit, we do this survey where we ask our clients what their beliefs are about the markets in the coming quarter or half a year, depending on the survey. We just got one in not too long ago, asking them about Q4 in 2024, and you see relative to Q3 last time when we asked, many people have moved from sort of the middle where they say, yeah, it's probably going to be a little bit good or a little bit bad. A lot of them had moved actually to it's either going to be very good or very bad. I guess that type of insecurity is somewhat justified in the realm we're living in right now.
Do you mean just the general outlook for markets?
Just insecurity, yeah, like whether it's going to go up a lot or down a lot.
Yeah, well, I think I made a presentation prior to the election saying these are the different scenarios, and this would be the scale of impact. Different scenarios meaning for president and combination of the president and control of Congress. And I put a red sweep at force 10. The second highest being Trump wins but does not get the House, force 5, just for perspective. Harris, gridlock, force 1, because that's basically status quo. And then Democratic sweep would be force 4. So force 10 means you have a lot of energy behind policy. So there's good reason to have maybe this bifurcation, this big swing in whether people are particularly positive. You see the crypto folks and the Tesla folks and the equity market in general thinking this is an unalloyed positive, and those that are concerned maybe about some of the things that concern us on the other side. So there are things that are quite positive for the market, quite positive for the outlook, but there are also huge questions, and how a new attitude and style and stance, especially in the great U.S.-China rivalry, what that will mean going forward. So I think it maybe just reflects that.
Makes a lot of sense. And I was just about to say that these times it sounds like it's almost time to do some outrageous predictions. And then I remembered that we're actually doing that 3 weeks from now.
Yeah, let's not spoil the party.
No, exactly. No, just wanted to say that is, of course, coming up as it has been for the past several years. And I hope everyone is looking forward to that. I am, at the very least, looking forward to see what you guys have drummed up. But I don't have anything more. Do you guys have anything else you want to leave the listeners with before we say goodbye?
We're all good. Let's see where we are next week.
Definitely. But Althea and John, thank you so much for sharing your insights on market news and all the other goodies that you have to offer. And as always, if you like what John and Althea are doing, you can find them on our platform, on our website. You can also find them on X if you want to have a look at what they're writing there. But apart from that, thank you all for tuning in to the Saxo Market Call. If you enjoyed today's episode, please rate us on your favorite platform or send feedback to saxomarketcall@saxobank.com. Join us next week for more insights into the global economy. Until then, stay informed and invest wisely.